Most people pick an ETF based on what is popular. The problem is, some of the most popular funds in the world are just more expensive versions of something better. The difference between picking the right ETF and the wrong one is not small. It's the difference between your $10,000 turning into $24,000 or turning into $165,000. Same starting amount, same time period, completely different lives. I took 12 of the most popular ETFs in the world and ranked every single one, from elite all the way down to avoid. In this video, I'm rating every single one, and here's what's going to surprise you. One ETF on this list outperforms almost everything above it on the leaderboard, and I'm still telling you to avoid it. By the end, you will know exactly which ETFs deserve your money and which ones do not. The gap between the top and the bottom of this list is over $146,000. And as a bonus, in the end, I'm going to take 3 ETFs from the top of this list and combine them into one portfolio and show you how this portfolio could turn $10 a day into over $1 million. Now, before I get into the rankings, I need to explain how this list works. These are the 12 ETFs, and they are ordered from lowest return to highest. As we move through the list, the numbers get bigger, but the tier rating does not follow the same order, because it's not just about performance. If it were, this would be a simple list sorted by returns, and we would all go home. But performance alone can be misleading. One ETF on this list has extraordinary returns on paper, and I still would not recommend it to most investors. You will see exactly why when we get there. Every ETF earns one of 4 tiers. Elite means I would build a portfolio around it. Great means it deserves a place in most investors' accounts. Good means it does its job well but has clear limitations. And avoid means a better alternative exists, and there is no good reason to own it. Diversification, cost, and real-world investor experience all factor into the rating, not just the headline number. So let's put the first one on the board, JEPI, one of the most popular income ETFs in the world and one of the fastest growing. This is not a traditional stock ETF. JEPI holds a basket of large-cap US stocks and then sells covered call options on the S&P 500 to generate extra income. That options premium is what funds an 8.2% dividend yield, paid every single month. For context, most S&P 500 ETFs pay around 1%. That monthly income is why JEPI has exploded to over $44 billion in assets since launching in 2020. And the way it is built is interesting. No single stock dominates. The largest position is Johnson & Johnson at just 2.2%, followed by HWM at 2.1%, ROST at 2%, and ADI at 1.9%. A massive 64.6% is spread across dozens of other positions with no single stock dominating, making this one of the most evenly distributed ETFs on this entire list. But that covered call strategy comes with a cost. It caps your upside. In strong bull markets, the kind we have had for most of the last 5 years, JEPI falls behind because it is trading future growth for current income. That's not a flaw, it is the design. For a retiree who needs consistent monthly cash flow, JEPI is one of the most efficient tools available. For someone in their 20s or 30s building long-term wealth, it's the wrong instrument entirely. Now, let's see how JEPI actually performed. If you had put 10 grand into JEPI at launch back in May 2020, when it came into existence, that investment would have grown to nearly $19,000 today. That is an 11.7% annual return, which on its own is a perfectly respectable number. But this is the first fund on the list, and the gap between this and what is coming is going to get very wide, very fast. So, where does JEPI land on the tier list? Good. It does exactly what it was built to do: deliver consistent monthly income at scale with broad diversification and no single stock carrying the weight. But it was never designed to build long-term wealth, and on a list where we are measuring total growth, that ceiling keeps it here. Income has a ceiling on this list. The next fund is not chasing income at all. It is chasing the broadest possible exposure to every market outside the United States. VXUS is one of the largest international ETFs in the world, with over $145 billion in assets. Over 8,500 stocks across Europe, Japan, China, India, the UK, Australia. If it is a publicly traded company and is not American, VXUS likely owns a piece of it. That makes it the most geographically diversified ETF on this entire list. No single country, sector, or company dominates. The largest holding is TSMC at 3.6%, followed by Samsung, ASML, and Tencent, all under 1.5% each. Over 83% of the fund is spread across thousands of positions. At a 0.05% expense ratio, this is one of the cheapest ways to own the entire world outside America. Now here is the honest part. US markets have dramatically outperformed international markets for over a decade. It has not been close. Owning VXUS over that period meant watching US-focused funds pull further and further ahead every single year. That is a difficult thing to sit through, and a lot of investors gave up on international exposure entirely because of it. But markets move in cycles. The US has dominated for 15 years, and that will not last forever. International markets have outperformed the US for long stretches before, and they will again. VXUS is not the fund you own to chase returns. It is the fund you own so that when the cycle turns, you are already there. If you had put 10 grand into VXUS 10 years ago, that investment would be worth just over $24,000 today. On this list, that is one of the lowest numbers you are going to see. But VXUS was never trying to win a performance race. It is a hedge against the assumption that US dominance lasts forever. So where does VXUS land on the tier list? Good. Exceptional diversification at near zero cost, and it serves a real strategic purpose in a portfolio. But 15 years of underperforming US markets is impossible to ignore, and that is what keeps it in good. $24,000 is the highest return on this list so far. By the end, one fund crosses $165,000. Another one near the top of the leaderboard still earns an avoid, and I'm going to take 3 funds off this list and build a portfolio that turns $10 a day into over $1 million. Every fund so far has owned the broad market or gone global. This one narrows the focus to a single sector, healthcare. VHT is the Vanguard Healthcare Index Fund, with over $17 billion in assets and around 400 stocks across pharmaceuticals, biotechnology, medical devices, and health insurance. The case for healthcare as a sector is simple. Demand is non-negotiable. People get sick regardless of what the economy is doing. Populations are aging globally, and pharmaceutical innovation is accelerating faster than at any point in history. That makes VHT significantly more defensive than growth-heavy ETFs when markets pull back. And right now, one company is carrying a huge part of VHT's performance. Eli Lilly sits at 12.4% of the fund, the single largest position by far, and the explosion of GLP-1 weight loss drugs like Ozempic and Wegovy has turned Lilly into one of the most valuable healthcare companies in the world. Behind Lilly, Johnson & Johnson sits at 8.9%, AbbVie at 6.3%, Merck at 4.5%, and United Health at 4.1%. That means the top 5 holdings alone account for nearly 36% of the fund. Despite holding 400 stocks, VHT is one of the more concentrated ETFs on this list, and a significant chunk of its recent performance comes down to one company's drug pipeline. That is the trade-off with any sector ETF. You get deep exposure to an industry you believe in, but you are betting entirely on one corner of the market. When healthcare leads, VHT looks brilliant. When it does not, you are watching the broader market pull ahead with no way to participate. If you had invested 10 grand into VHT 10 years ago, that investment would be worth just over $26,000 today. A solid result for a defensive sector fund, but it shows exactly what happens when you trade broad market exposure for a single sector bet. VHT earns a good, and for the right investor, someone who wants healthcare exposure without picking individual pharma stocks, it is a smart fund. But on this list, it is going up against funds with far broader reach and lower concentration risk. That is a fight a single sector ETF cannot win. 3 funds in, 3 good ratings. This is where that changes. SCHD is the Schwab US Dividend Equity ETF, nearly $84 billion in assets, and easily the most popular dividend ETF in the world. And when you understand what this fund actually does, that popularity is completely earned. SCHD tracks 100 US companies selected specifically for one thing: their ability to pay and consistently grow their dividends. It screens for cash flow, return on equity, dividend yield, and dividend growth rate. Only financially strong companies make the cut, and the result is a portfolio that looks nothing like most popular ETFs. No Nvidia, no Apple, no Microsoft. SCHD deliberately avoids high-growth tech in favor of companies that generate cash and return it to shareholders. Names like Lockheed Martin, ConocoPhillips, Verizon, Chevron, Coca-Cola, and Pepsi. Now here's the number that makes SCHD special. The current dividend yield is 3.38%, already well above most ETFs on this list, but the dividend itself has been growing at 10.61% annually for the last 10 years. That means if you bought SCHD a decade ago, you are not earning 3.38% on your original investment anymore. You are earning significantly more, because the dividend never stopped growing, and the whole thing costs 0.06% a year. That is $6 annually on a $10,000 investment. So how did SCHD actually do? $10,000 invested 10 years ago grew to just over $32,000. That is a noticeable step up from everything we have seen so far. And remember, that is just the price appreciation. SCHD was also paying you income every quarter that kept getting larger year after year. That makes SCHD the first great on the tier list. No other dividend ETF on this list combines income, dividend growth, and capital appreciation at this cost. It is the best dividend ETF here, and it is not close. Before we continue, I want to show you something most investors completely ignore. Every ETF charges an annual expense ratio, and on the surface, these numbers look tiny: 0.06%, 0.09%, 0.35%. What is the difference, right? Take a $10,000 portfolio. SCHD at 0.06% costs you around $180 in total fees over 30 years. VHT at 0.09% costs $270. But JEPI at 0.35% costs you over $1,050 from the same starting investment. These fees do not show up on a statement. They leave your account silently every single year, compounding against you for decades. Keep that in mind, because one ETF still coming up on this list charges 0.75%, more than double what JEPI charges, the highest fee on this entire ranking. And when you see what that fund actually delivered for that cost, it's going to change how you look at every expense ratio from this point forward. The next fund is going to look familiar, and that's the point. DGRO is the iShares Core Dividend Growth ETF. With nearly $38 billion in assets, it sits in the same category as SCHD. Both are dividend ETFs. Both focus on companies that consistently grow their payouts. But DGRO does something SCHD does not. It lets tech companies in the door. DGRO holds around 400 stocks, companies that have grown their dividends for at least 5 consecutive years and have the earnings to keep doing so. And when you look at the top holdings, the difference from SCHD is obvious. ExxonMobil leads at 3.7%, Johnson & Johnson at 3.4%, AbbVie at 2.7%, familiar dividend names. But then you see Apple at 2.6% and Microsoft at 2.4%. These are companies that have started paying and growing dividends in recent years, and DGRO captures that growth tailwind that purely traditional dividend ETFs like SCHD miss entirely. Over 58% of the fund sits across hundreds of other positions, making it one of the more diversified dividend ETFs available. Now, here is the DGRO versus SCHD conversation, and it usually starts with this question: which one is better, DGRO or SCHD? It depends on what you want. SCHD pays you more income right now, 3.37% yield versus DGRO's 2.02%. But DGRO has delivered stronger price appreciation thanks to that tech exposure. If you need income today, SCHD wins. If you want a higher total return with a growing dividend over the long term, DGRO makes a real case for itself. And the numbers back that up. $10,000 in DGRO 10 years ago is worth just over $34,000 today, roughly $2,000 more than SCHD over the same period. Not a massive gap, but enough to show that the tech exposure made a measurable difference. $2,000 more than SCHD is real, but it is not enough to separate them by a tier. DGRO earns a great, same as SCHD. Two different approaches to dividend investing, both earning their place. Which one you pick depends on whether you want more income now or more growth over time. Up to this point, every fund on this list has had a focus: income, international, healthcare, dividends. This one does not pick a lane. VTI is the Vanguard Total Market Index Fund, over $586 billion in assets, and it owns the entire US stock market in a single fund. Over 3,500 stocks, large cap, mid cap, small cap, micro cap. If it is publicly traded in the United States, VTI owns it. The top of the fund looks like every major index: Nvidia, Apple, Microsoft, Amazon, Google, Meta. But what makes VTI different from an S&P 500 fund is everything underneath. Hundreds of mid-cap and small-cap companies that no other ETF on this list touches. That extra depth means you are not just riding the biggest names, you own the next generation of companies before they become household names. Here is the simplicity argument. One fund, 0.03% cost, the entire US market. For an investor who wants maximum diversification with zero complexity, VTI is the answer. It does not get simpler or more cost-efficient than this, and the long-term numbers back it up completely. 10 grand in VTI 10 years ago grew to just over $38,000. That is a meaningful jump from the great tier, and it got there without picking sectors, screening for dividends, or relying on any single strategy. It just owned everything and let the market do the work. That simplicity is exactly why VTI earns the first elite on the tier list. Maximum diversification, minimum cost, decades of proven compounding. For an investor who wants one fund and never wants to think about it again, this is the answer. We are halfway through the tier list, and up to this point, the highest return has been 38 grand from VTI. Every fund from here on outbeats that number, some of them dramatically, and the ratings are about to get a lot more controversial. Now, next up, if you have ever invested in anything, you have probably been measured against this fund, whether you knew it or not. VOO is the Vanguard S&P 500 ETF, $872 billion in assets, the single largest ETF ever created, and the benchmark the entire financial industry is built around. Every hedge fund, every mutual fund manager, every financial advisor charging you a percentage of your portfolio, they all measure their performance against the S&P 500. And here's what decades of data consistently show. The overwhelming majority of them lose. Not over one bad year. Over 10-year, 15-year, 20-year stretches, most professional money managers with teams of analysts, proprietary models, and billions in resources cannot beat this index. VOO lets you own that index for 0.03% a year. $3 on a $10,000 investment. You are paying $3 for what entire Wall Street firms charge thousands to try and replicate and fail. Now, the question you are probably asking, I just gave VTI an elite, and VOO holds almost the same stocks at the same cost. So what's the difference? Honestly, it is small. VTI owns over 3,500 stocks, including mid-caps and small caps, that VOO does not touch. VOO concentrates on the 500 largest. 10 grand in VOO 10 years ago grew to just over $39,000, barely ahead of VTI's $38,000. You cannot go wrong with either. The decision between VTI and VOO is a preference. Choosing either one is the right call. VOO earns an elite. I could make this complicated, but it is not. It is the gold standard of index investing, and the benchmark every other ETF on this list is measured against. The overwhelming majority of professional fund managers cannot beat it. Everything up to this point has earned its place on the tier list. This next one is different. IWF is the iShares Russell 1000 Growth ETF, with nearly $117 billion in assets, one of the largest growth ETFs in the world, and on paper, it looks like a serious contender. It holds around 390 of the largest and most growth-oriented companies in the US market. Nvidia leads at 12.3%, Apple at 11.2%, and Microsoft at 9.1%. Over 71% of the fund is concentrated in just the top 10 stocks, and the returns reflect that concentration. 10 grand in IWF 10 years ago is worth just over 50 grand today. That is the biggest jump we have seen on this list so far, a massive leap from the 39,000 that VOO just delivered. And if I stopped right here, you would have every reason to think this belongs in elite. But this is exactly why I said at the start of this video that performance alone can be misleading. IWF charges 0.18% in fees, and the very next fund on this list holds almost identical stocks, delivers better annual returns, and charges 0.04%. That is 4.5 times cheaper for a better result. When a clearly superior alternative exists in the same category at a fraction of the cost, there is no good reason to own the more expensive version. That is like paying full price for a product when the exact same thing is on sale one shelf over. I'm not putting IWF in elite. I'm not even putting it in great. IWF earns an avoid. 50 grand from 10 grand is an impressive number, but impressive does not mean optimal. And on a list where a nearly identical fund does the same job better for less, IWF simply cannot justify its place in your portfolio. Next on the list is SCHG, the Schwab US Large Cap Growth ETF. And I want you to pay close attention here because this could be the most underrated ETF on this entire list. Most investors have never heard of it, and that is a mistake. SCHG was launched in December 2009 by Charles Schwab and has grown to over $50 billion in assets. It holds the largest US companies with strong growth characteristics, and if you were thinking that sounds exactly like IWF, you're right. The top holdings are nearly identical: Nvidia, Apple, Microsoft, Amazon, Meta, Google, Tesla, the same names in roughly the same proportions. The difference is what you pay for them. IWF charges 0.18%, SCHG charges 0.04%. That is 4.5 times cheaper for what is essentially the same portfolio. And here's what makes it worse for IWF. SCHG does not just cost less, it actually delivers better annual returns. 10 grand in SCHG 10 years ago is worth just over $51,600 today. That is $1,000 more than IWF, while charging a fraction of the fees. You are getting a better result and keeping more of your money. There is no angle where IWF wins this comparison. SCHG earns an elite rank, better returns than IWF at 4.5 times lower cost, and the fact that most investors do not even know this fund exists is exactly why I made this list. If there is one fund on this entire ranking that deserves more attention than it gets, it is this one. SCHG proved that you should never overpay for a growth ETF when a cheaper version exists. So here is a fair question. QQQ charges 0.2%. That is higher than IWF. So where does that leave it on this list? QQQ is the Invesco QQQ Trust, the most widely owned growth ETF in the world. Over $391 billion in assets and one of the most heavily traded securities of any kind on the planet. It tracks the NASDAQ 100, the 100 largest non-financial companies on the NASDAQ exchange. Nvidia leads at 8.7%, Apple at 7.5%, Microsoft at 5.9%, Amazon at 4.5%, Tesla at 3.9%. These are the companies that define the smartphone era, the cloud era, and now the AI era, all in one fund. QQQ is concentrated in tech but well spread across the most dominant companies, driving the modern economy. But QQQ is not a fund you hold without understanding what you own. In 2022, it dropped nearly 33%, 1/3 of your investment, gone in a single year. The investors who benefited most from QQQ are not the ones who bought at the right time. They are the ones who held through that drawdown instead of selling at the bottom. That is the price of admission with a concentrated growth fund. The gains are extraordinary, but so are the drops. And the gains have been extraordinary. 10 grand in QQQ 10 years ago is worth just over $61,000 today. That is a $10,000 jump from SCHG, and it puts QQQ in a category that only one other fund on this list is going to reach. So, back to the question, does QQQ justify that 0.2% fee? Here is the difference between QQQ and IWF. IWF had a cheaper alternative doing the same job better. QQQ does not. No other fund replicates the NASDAQ 100 at a lower cost with this scale and liquidity. The fee is the only real criticism, and on a fund with this track record and no cheaper equivalent, it is a cost worth paying. QQQ earns an elite. 4 elites, $61,000 at the top. What comes next are the 2 most controversial calls on this entire list. One crossing $165,000, another earning an avoid despite beating almost everything above it. And once the rankings are done, I'm building a 3-fund portfolio that grows $10 a month to over $1 million. Stay with me. QQQ charges 0.2% and earned its place. The next fund charges 0.75%, the highest fee on this entire list. And this is the moment I told you about at the start of this video. ARKK is the ARK Innovation ETF, and it is unlike anything else on this list. Every other fund we have looked at tracks an index. A set of rules determines what goes in and what comes out. ARKK does not work that way. This is an actively managed fund, meaning Kathy Wood and her team at ARK Invest are making buy and sell decisions every single day. You are not paying for an index, you are paying for a person's judgment. And look at what that judgment has chosen. Tesla at 10.2%, CRISPR at 6.7%, Roku at 5.1%, Shopify at 4.8%, Coinbase at 4.6%, and Roblox at 3.3%. These are not stable compounding businesses. These are volatile, high-conviction bets on companies where the price can swing 30 or 40% up or down in a single quarter. And the chart makes that painfully clear. In March 2025, ARKK was sitting at nearly 50 grand. By the end of April, it had dropped to around 30 grand, a 40% decline in less than 2 months. It then surged all the way to over $85,000 by October, only to crash below 60 grand shortly after. 2 massive drops, both over 30% in the same year. Most investors cannot sit through that without making a mistake. And yet, if you had invested 10 grand in ARKK at inception, that investment would be worth nearly $63,000 today. It sits above QQQ on the leaderboard, above VOO, above VTI. If you are looking at that number right now, you're probably thinking this has to be elite. But that number hides what actually happened to real investors who own this fund. ARKK peaked at nearly $160 per share in early 2021, Then it lost over 75% of its value in less than 2 years. Most investors did not buy at inception. They bought during the hype, near the top, and rode it all the way down. The single inception number tells you what a perfect entry point returned. It does not tell you what the average ARKK investor actually experienced. And you are paying 0.75% a year for that ride. Remember the fee reality check? That is more than double what JEPI charges and over 12 times what VOO costs. You are paying a premium for active management that has consistently failed to beat simple index funds over the long term. When the strategy is riskier, the fees are higher, and the results are worse than a basic index, that is not innovation. That is a trap. I'm not putting ARKK in elite. I'm not putting it in great. I'm not even putting it in good. ARKK earns an avoid. The since inception number sits near the top of the leaderboard, and the real investor experience sits nowhere close to it. That is exactly why I said at the start of this video that performance alone can be misleading. This is the fund I was talking about. We have seen 10 grand turn into 19 grand, 32 grand, 51 grand, and even 63 grand. Nothing on this list has prepared you for what this last fund did with the same 10,000. It is called SMH, the VanEck Semiconductor ETF. Just 25 stocks. Every single one is a semiconductor company. On paper, this fund violates everything a diversified investor is supposed to believe in. It tracks the MVIS US-listed Semiconductor 25 Index, the 25 largest semiconductor companies in the United States. One industry, no safety net, pure concentration, and the results are unlike anything else on this list. So why has that bet paid off so extraordinarily? Because semiconductors are not just another sector. Chips are the foundational infrastructure of the modern economy. Every AI model runs on them. Every smartphone, every data center, every electric vehicle. The entire digital world is built on top of what these 25 companies produce, and SMH owns every major company at the center of that demand. NVIDIA sits at 18.8% of the fund, the single largest position on any ETF on this entire list, and NVIDIA alone has returned over 2,000% in the last 5 years. That one holding has been the single biggest driver of SMH's extraordinary performance. Behind NVIDIA, TSMC sits at 11%, Broadcom at 7.7%, Micron at 6.3%, and ASML at 5.8%. The top 5 holdings alone account for nearly half the fund. This is concentration at a level that nothing else on this list comes close to. And now the number this entire video has been building towards. 10 grand in SMH 10 years ago is worth over $165,000 today. Read that again. $165,000 from 10 grand. That is not just the highest return on this list, it is in a completely different category. The gap between SMH and the next closest fund is larger than most funds on this list returned in total. Now, you would think a fund that turns 10 grand into $165,000 automatically earns the highest tier on this list. It does not. That $165,000 came from a 25-stock single industry bet. If semiconductors hit a prolonged downturn, and every industry eventually does, there is no diversification to cushion the fall. SMH dropped over 35% in 2022. An investor who panicked and sold during that drawdown did not get anywhere near $165,000. The returns are extraordinary, but they require a level of conviction and risk tolerance that most investors do not have. SMH earns a great, the highest return on this entire list by a margin that is hard to believe, but elite is reserved for funds that most investors can hold through anything without losing sleep. SMH demands more from you than that, and that is what keeps it one tier below. And there it is, all 12 ETFs, same 10 grand, completely different outcomes. Starting at the bottom, the 2 avoids. IWF sits above VOO and VTI on the performance chart, yet earns an avoid because a nearly identical fund does the same job at 4.5 times lower cost. ARKK sits near the very top of the leaderboard and still earns an avoid, because the since inception number hides an investor experience that most people could not survive. In the good tier, JEPI, VXUS, and VHT. Each one does its job well. Income, international diversification, healthcare exposure. But each one has a ceiling that keeps it out of the conversation for building long-term wealth. In great, SCHD, DGRO, and SMH. SCHD and DGRO are the 2 best dividend ETFs on this list, and SMH produced the single highest return by a margin that is hard to believe, $165,000 from 10 grand. But concentration risk keeps all 3 one tier below the top. And at the top, elite. VTI, VOO, SCHG, and QQQ. These four did not just perform well, they performed well at a cost and a risk level that most investors can actually live with for decades. That is the difference between a good number and a good investment. The gap between the top and the bottom of this list is over $146,000 from the same starting investment over the same time period. Performance got every fund on the leaderboard. It did not earn all of them a tier. Now you know the tiers. Here is what you actually do with them. I'm taking 3 ETFs from the top 2 tiers of this list and building one portfolio. 3 funds, $10 a day investment, which comes to about $300 a month. That is it. VOO gets half, $150 a month. It's the core, the benchmark that the entire financial industry cannot beat, at a cost that is essentially free. It gives you broad exposure to the 500 largest companies in the US and anchors the entire portfolio. SCHD gets a third, $100 a month. This is the income engine, a 3.37% dividend yield that has been growing at over 10% a year for the last decade. While VOO drives the growth, SCHD is putting cash in your pocket every quarter, and that cash keeps getting larger. QQQ gets the rest, $50 a month. This is the growing accelerator. The NASDAQ 100 has been the most powerful wealth creation engine in modern investing over this period, and even a small allocation gives this portfolio a meaningful performance boost. At around 17% of the total investment, it adds upside without taking over. When you blend those 3 together, the portfolio yields 1.77% in dividends, grows that dividend at 8.18% annually, and appreciates at 12.74% a year in share price. 3 funds doing 3 different jobs working together. Now let's talk about what that actually turns into. If you invest $300 a month, that's $10 a day, and let it compound, after 10 years, your portfolio is projected to cross $69,000. You have put in $36,000 out of pocket. The rest is pure growth. After 21 years, it surpasses $319,000. And after 30 years, from a total investment of just $108,000 out of your own pocket, your portfolio reaches over $1.18 million. That is the strength of using 3 solid ETFs working together. If you want to take that same 10 grand and put it into 5 dividend stocks that could grow to over $1.18 million and pay you over 5 grand a month, enough to replace your 9 to 5, click the video on the screen.